Okay guys, we are at module 2.5, margin in Forex. This is the last section in module 2 series. In this section, we're going to look at what is margin, type of different margins, how margin is calculated, margin calls, and how margin shows up in MT4. Alright, let's get started. What is margin in Forex? Margin is the cash balance required by broker in order to open up a leverage position. Of course, the broker will give you the leverage, but you still have to maintain a cash balance requirements. Margin requirements differ from broker to broker. They also differ by the pair you trade. Now let's go and take a look at different type of margins in the next slide. Type of margins. Let's take a look at different type of margins that we have. First, required margin. Required margin is the initial amount of cash balance you are required to open a position. So when you're opening up a position, this balance is required by your broker. Used margin is the amount of money set aside by your broker to maintain an open position. This amount is released when a position is closed. Account margin is the amount of money in your trading account. Free margin is the account margin minus the used margin, is the balance available to open a new position. For example, if you want to open up a second position, your account margin minus the used margin is how much you have available to trade. Okay, don't be confused by the terminology here. We're going to take a look at how required margin is calculated, what is used margin, and what is account margin, and what is free margin in detail, and how they show up in MT4 as well. The most important terminology, if you ask me here, is the required margin and the free margin. Because when you want to open up a position, you want to know what is required by your broker, and you also want to know how much is free in your account. Okay, we're going to take a look at how required margin is calculated. Required margin is calculated using the formula, which is a full position divided by the leverage allowed by your broker. Okay, let's take a look at an example. We're just going to calculate the full position size first. Then we're going to move on to the next slide to finish off the rest of the calculation. Okay, how to calculate the full position size first. Let's say we are trading Euro US with the quote price of 1.2. So in this case, if we are trading a standard lot, which means 100,000 of the base currency, times 1.2, 120,000 in value. If we are trading a mini lot, it would be 10,000 in base currency times 1.2, which would be 12,000 in value. Okay, now we know the full position size pricing for a standard lot and also for the mini lot. Let's move on to the next slide and do the rest of the calculation. Okay, let's take a look at the rest of the calculation. So we calculate the full position size, which is 120,000 for a standard lot, divided by the allowed leverage and the required margin amount that we have to put up to take that position. Okay, let's take a look at the chart here. So if we are using a 50-to-1 leverage, it would be 120,000 divided by 50, which is about 2,400 US dollar when we are trading the Euro US. If we are trading 100-to-1 leverage, it would be 120,000 divided by 100, which is about $1,200 US. If we are doing a 500-to-1 margin, it would be $240 US. That's how much we have to put up to trade a position size of $120,000. Okay, this is how required margin is calculated, and as you could see, as more leverage you're using, the less you have to put up. But you are increasing the risk as we seen in the previous lecture. So use it wisely because small account could get wiped out really fast if you take unreasonably big position sizes. So keep your position sizes reasonable to your account size. Don't try to hit the moon with one trade. Here's an example of reasonable trade with the mini lot instead of a full lot. We are only trading about $12,000. So if we are doing, let's say our biggest leverage allowed 500 to 1, it would be 12,000 divided by 500, and which is about $24 required margin for that mini lot. So even with the small account, that leverage become manageable. But if you trade a large position size in respect to your account balance, then even a few pip move could wipe out your account. So the total risk you should take is about 2% for trade, 2% of your account size per trade. So if you manage the position size according to that, then you could be a winner over a long time. Okay, let's take a look at how required margin is calculated for a different pair here. We're going to take a look at Euro Canadian. First, we're going to calculate the full position size. So the standard lot is 100,000 times 1.4, which is a quoted price here, which is 140,000 Canadian. A mini lot is 10,000 times 1.4, which is 14,000 Canadian. Okay, let's move on to the next slide. So we're going to look at the standard lot first, $140,000 Canadian divided by the allowed leverage, and we get the required margin. So for 50 to 1, it would be $140,000 divided by 50, which is 2,800 Canadian. Of course, if you have your account in US dollars, your broker will convert that into US dollar and give you the required margin in US dollars. So for 500 to 1, it would be 140,000 divided by 500, which is $280. Here's a calculation for Euro Canadian mini lot. We have a full position size of 14,000 divided by the allowed leverage, then we get the required margin. Here are some examples with the allowed leverage of 50 to 1. 14,000 divided by 50, so 280 Canadian is the required margin. Like I said earlier, if you have your account in US, your broker will convert that into US. So for 500 to 1, 14,000 Canadian divided by 500, we got $28 Canadian. So that's how leverage is calculated. And these position size, it depends on your account size. Put in your position according to your account size to avoid margin call. We will take a look at margin call next. Margin call. Margin call is the worst thing that could happen to an account. Margin call is a warning message from your broker to add more funds when potential losses cannot be covered with available cash balance in your account. Margin calls happens when an account margin drops below used margin levels. If you don't respond immediately and add funds to your account, you are at risk of all positions or some of your positions being liquidated by your broker. Later in the course in risk management, we will take a look at how to avoid margin calls by managing our position sizes properly. Okay, let's take a look at how MT4 shows their margins. Here we have MT4 open. It shows us the free margin over here. This is the account margin. Now I'm going to enter into a trade. I'm entering a one standard lot buy on the Euro US. Okay, now I'm in the trade. I'm have one standard lot trade on the Euro US. So this is the free margin we have available there. And the margin that we are using over here. And this is the account margin. So let's try to enter one more trade that's out of our margin level. So if I'm entering, let's try to enter a 5 standard lot trade. So not enough money. So we're going out of our margin level. So that's why we're getting that error message. So we could still enter one more standard lot trade according to the margin that is available, because for one standard lot, we're only using 2,394.26. Remember, this is a 50-to-1 margin level account, leverage level account. Okay, that's how MT4 shows you the margin levels. Okay, we are at the end of module 2.5. What is margin? Let's move on and have a quick look at swap next.